Government debt sounds alarming. Trillions of dollars, endless borrowing, permanent deficits. But what does government debt actually mean? And how can countries keep borrowing without going bankrupt? Let's break this down simply. Governments spend money constantly. Infrastructure, healthcare, defense, social programs, crisis response. But tax revenue rarely matches spending perfectly. When expenses exceed income, the gap is covered by borrowing. This borrowing happens through government bonds. In simple terms, a government bond is an IOU. Investors lend money to the state today, and the state promises to repay it later with interest. These bonds are bought by banks, investment funds, pension systems, and central banks. This is where a common misconception appears. Government debt is not like household debt. A family must eventually repay everything from limited income. A sovereign state operates differently. It can refinance, roll over debt, and issue new bonds to replace old ones. Debt for governments is less about repayment at a fixed moment and more about sustainability. As long as investors trust the country, borrowing continues smoothly. Confidence is the real currency. Why do investors lend so much money to governments? Because major states are seen as reliable borrowers. They have taxation power, economic output, political stability, institutional continuity. Default is rare and extremely costly for any country. Government debt also plays another role. It provides safe assets for the global financial system. Large investors need stability. Government bonds often become the foundation of portfolios, collateral systems, and financial markets. But debt does carry risks. If borrowing grows faster than the economy, pressure increases, interest payments rise, budget flexibility shrinks, and confidence can weaken. This is why analysts focus not on total debt alone, but on ratios: debt relative to GDP, debt servicing costs, market demand, currency stability. Context matters more than raw numbers. There is also a paradox. In times of crisis, investors often buy more government debt, not less. Uncertainty drives demand for perceived safety. Debt markets can expand precisely when fear rises. Will government debt ever disappear completely? Historically, almost never. Modern economies are built around continuous refinancing. Debt becomes part of the system, not an exception to it. The real question is not whether debt exists, but whether it remains manageable. Stable growth, controlled inflation, and investor confidence are what keep the structure intact. Government debt is not simply a burden. It is also a mechanism, a tool, a stabilizer, and sometimes a necessity. If you want calm, clear explanations of global economics and geopolitics, subscribe to Global Analysis Point. Thanks for watching, and see you in the next analysis.